In this video, I am going to predict where the S&P will be in 2030. Guys, I'm your Uncle Paul, and I've been investing in the stock market, businesses, and real estate for over 25 years, even though I'm only 42 years of age. Now, the data I'm about to show you is going to show where the market could be in 2030. I'm a data-driven guy. I like to look at the numbers and see where we've been in history, because even though history doesn't repeat itself, it often rhymes.
Yep.
I don't know if you've heard that quote before. I love it because history will never go exactly as it did, but it'll be very similar. So Warren Buffett says the most reliable metric at any given time on where the S&P is a stock market to GDP ratio. What that does is it takes the entire market cap of the stock market, divides it by GDP, and gives you some sort of ratio. This was very big, and guess what? In bull markets, people say it's useless. In bear markets, people say it's awesome. Guess what people are saying now, Mo?
Useless.
You should see how many comments I get from people saying,
outdated.
Paul, so much money is generated overseas now, you can't really look at this metric. Okay, I'm quite sure that if you look at the stock market to world GDP ratio, which I should create, by the way, to look at that and say, okay, let's see where that goes.
Let's use this one.
At the end of the day, guys, it's all about looking at value and realizing that every investment is the present value of all your future cash flow. Listen to that again if you're new to the channel. Every investment is the present value of all the cash flow you're going to receive in the future. All you're doing is saying, if I pay X amount of dollars today, whatever that cash flow is in the future, if I bring it back, it's going to tell me this is your return on that money. If I put $100 saved for investment and I get $1 a year for the next 100 years, I made $100, but it took 100 years to do that. What's my return there? It's 1% or so. That's garbage. Now, if I invest $100 today, I get $100 a year for the rest of my life. That return is insanely high, well over 100%, because I get my money back in the first year, and then I'm able to reinvest those profits into more and more opportunities to generate higher and higher returns. So what I did was I created my own stock market to GDP ratio going back to 1929. I used the S&P. Since it's a market-based index, I just use the index value, okay? And I divide it into the total GDP of the U.S. economy. I have it right here. And every single day, every market day, I report to our community here. I sit here and show in our Paul Stock Market Indicator, I sit there and report the ratio at that given time. Right now, based on where the GDP is today, and I have to update it for September 30th when that number comes out. This morning, we were at 4308.50, and we were 72.3% overvalued. It says the S&P's fair value is 2,500. Now, before you guys take a dump on this and start saying, oh, so much revenue is generated and profits generated overseas, fine, I get it, guys. I look at it going, Warren Buffett still hasn't given up on this thing, and he's a pretty smart thinking guy. And I'm sure there are issues.
Track record.
Just like EPS, earnings per share. Guess what? We don't calculate earnings per share the same way we do today that we did 25 years ago, 30 years ago. Does that mean we go out there and change it? No. And for those of you also who want to understand it, I also have the 10-year cyclically adjusted PE ratio, which takes all the profit of the S&P 500 companies, no matter where that profit is earned, foreign or here. So for those of you who say this metric is dumb, I have a little surprise for you. Just stick on it a little bit. So we're at 72.3%. And as you can tell, we've been overpriced for a long time. We were as high as like 103, 107, things like that. But here's what happened in history. The average 10-year return, not including dividends, is 6.6%. When you're undervalued by 30% or more, the return's been 10.9. 0% to 30% undervalued, 9.3. 0% overvalued to 30% overvalued, 2.3. And it gets worse as time goes on. And guys, this makes sense. The less you pay, the more return you get. The more you pay, the less return you get. Is that not intuitive?
Very intuitive.
So what does that say here about where we expect? Well, guys, this is over the next 10 years, and it's 2023 right now, so 2033. I'm not going to sit here and say this is exactly where the market's going to be. What I'm going to say to you is we're 72% overvalued. Expect some volatility. Because every time this has happened, let's go back in history. During the dot-com bubble, look at the next 10-year returns here. -2, -6, -2.8, -3.2, -4.8. All these negatives and very low numbers. Okay, let's go back to when things were grossly undervalued. Early 1980s. Look at the returns here. This is green and undervalued. 10, 10.2, 11.1, 12.1, 14, 13.6.
All double digits and some big numbers there.
So the less you paid, the more return you make. So again, this is the stock market to GDP ratio. We created this chart. This was done by Matt, my statistics friend. He sat there and looked at the ratio and said, okay, what can we predict the next 10-year returns to be? Well, the current ratio is 1.6. So we go to 1.6 right here, 1.5 to 2. So 1.6 is about right there. So it's expecting, literally, it's right there, basically a little bit below the line, right here. You're basically at negative returns, not including dividends. So add another couple percentage points for dividends. So it's very likely that 10 years from now, the S&P is at today's level or lower. For those of you who don't believe me, hey, listen, it could very well not happen that way. Look at 10 years ago, 2013. 2013 projected returns were, it was about at 1. So the returns were going to be, it was a little overvalued. We were at 1.017, which gave returns potential of about 5% a year. And guess what they did? They did way more than that. So it can be very wrong. It did about 10% a year from June 2013, 10% per year. And it projected it was 5% a year. So it worked out great. Now what happened in that time? Look at GDP. GDP was 16.7 trillion and was very stagnant and then just skyrocketed. Yeah. GDP is now 70% higher than it was back then. And it makes sense. As GDP grows, which is the income of the country, value of the companies that are in there should be higher. Makes perfect sense. Mm-hmm. Mo, what do you think about this whole thing? Do you sit there and do you let this make any investing decisions for yourself?
No.
I used to.
Yeah, I don't.
I used to completely.
I look at it as, okay, over the next 10 years, let's say that we're at today's market. Okay, that's fine. But I look and say in 20 years and 30 years and 40 years, because I'm 35 right now. So yeah. Let's say 30 years is basically my horizon to retirement, whatever. Yeah, I don't think this is really going to matter very much.
It shouldn't matter to you. But what it should do is let you remember there's going to be volatility along the way.
And just accept it.
Yeah.
If you want to be in the market and involved in this stuff, you have to accept it.
And you got to realize that volatility will give you an opportunity to buy companies and indexes at much lower prices. Every time you look at history, there's been bad things that happen in the last 25 years. And what has happened in the stock market since then? It's just gone up. Now it's had its bumps along the way. That's why you're here watching this channel. I want you to subscribe to this channel before we get into the 10-year cyclically adjusted PE, because I want you to see that, I want you to hear it. When times are bad, I'm going to be the person out there telling you everything will be okay. This is a great time to buy. All the other Yahoo finance guys on YouTube who think they're smart, who are all idiots, will be changing to something else. Their tune will change. Absolutely. Just like the Workhorse, the Tattooed Chef, the Neo, the ones they sat there and said, these are going to the moon. They're down 95. Some of them are bankrupt. Some of those companies are bankrupt and they don't talk about them anymore for that exact same reason. All right. So the 10-year cyclically adjusted PE ratio, what that does is it takes the last 10 years of earnings on the S&P, brings it to today using inflation, and then divides the S&P 500 by that price. Historically, it's about 17. That's the historical average going back to 1929. Here it is as of today. It's currently at 29.45, which is 72.9% overvalued, higher than the other one. So for all you haters out there who hate the stock market GDP ratio and just care about overall earnings, it's worse. It's actually worse. It says fair value is 24.92, which is basically 2,500, the same level. But I don't want to hear it. I just don't want to hear it. This is just, guys, I'm just looking at it saying it makes perfect sense. The more you pay for something relative to earnings, the less you're going to make. How does that not make sense? If I told you something's going to make $100 a year for the rest of your life and you pay $10 billion for it, you're not going to do well. If you pay $1 for it, you're going to kill it. That's it. All that you're looking at when you buy a company is you're buying a future stream of income. You're buying a piece of a business, and that business is going to generate cash flows. And if it doesn't, that's okay, but you got to have a path to that cash flow. So guys, again, if you like this, subscribe to the channel. You're gonna love it when things get tough, when I'm sitting here talking about the right process and how to invest for the long run. Thank you for your time.